Imagine you carefully plant a garden with a balanced mix of plants. A year later, some have grown wild and tall, others have stayed small. The garden no longer matches your original design. Investment portfolios drift in exactly the same way. Rebalancing is the quiet practice of bringing your portfolio back to its intended shape. It sounds simple, but it solves a surprisingly deep problem. Let us start with the idea of an asset allocation. When you build a portfolio, you choose a mix, perhaps a certain portion in stocks and a certain portion in bonds, along with other assets. That mix reflects your goals, your time horizon, and your comfort with risk. It is the blueprint. Rebalancing is simply the maintenance that keeps the real portfolio close to that blueprint. Here is why portfolios drift. Different assets grow at different rates. When stocks rise sharply, the stock portion of your portfolio becomes a larger slice than you intended. When bonds outperform for a while, the bond portion swells instead. Over months and years, the mix you carefully chose slowly morphs into a different mix that you never actually decided on. Why does this drift matter? Because it quietly changes your risk level without your permission. If your stock portion grows much larger than planned, your portfolio becomes more aggressive than you intended. A market downturn would then hit harder than you prepared for. Drift does not announce itself. It just slowly moves your risk to a place you never agreed to stand. Rebalancing fixes this. To rebalance, you compare your current mix to your target mix. Then you adjust, by trimming the portions that have grown too large and adding to the portions that have shrunk. The result is a portfolio nudged back toward its blueprint. It is not about chasing performance. It is about restoring the design you chose with a clear head. Let us walk through a simple example. Imagine someone targets a mix of mostly stocks and some bonds. After a strong run in stocks, their portfolio is now far more stock-heavy than planned. To rebalance, they sell a portion of stocks and buy bonds, or they direct new contributions toward bonds, until the mix matches the target again. The blueprint is restored. Notice the hidden discipline inside that example. Rebalancing often means selling some of what has done well and buying some of what has lagged. That feels counterintuitive. Our instincts say to pile into winners and avoid laggards. Rebalancing gently enforces the opposite. A structured, unemotional version of buying relatively low and trimming relatively high, without trying to predict anything. This is the psychological gift of rebalancing. Investing is hard not because the math is complex, but because emotions interfere. Greed pushes us toward what is hot. Fear pushes us away from what is down. Rebalancing replaces those impulses with a rule. You are not guessing the market. You are simply following a process you designed during a calm moment. So how often should someone rebalance? There are two common approaches. One is time-based. You check and rebalance on a set schedule, perhaps once or twice a year. The other is threshold-based. You rebalance only when an asset drifts beyond a certain distance from its target. Both work. The best one is usually the one a person will actually stick with consistently. There is a balance to strike with frequency. Rebalancing too rarely lets drift build up, so your risk wanders far from your plan. Rebalancing too often can create unnecessary activity, and in taxable accounts it may trigger more taxable events. Most long-term investors find that a calm, periodic check, rather than constant tinkering, fits both their portfolio and their peace of mind. One of the gentlest ways to rebalance is with new money. If you are regularly contributing to your portfolio, you can simply direct fresh contributions toward whichever portions have fallen below target. Over time, this nudges the mix back toward the blueprint without selling anything. For people still building their portfolios, this can be the smoothest method of all. Taxes deserve a mention. In tax-advantaged accounts, rebalancing by selling and buying usually has no immediate tax consequence. In regular taxable accounts, selling assets that have gained value may create a taxable event. This does not make rebalancing wrong, but it does mean it should be done thoughtfully. Using new contributions or rebalancing inside sheltered accounts can soften this. It is also worth being clear about what rebalancing is not. It is not market timing. You are not predicting tops or bottoms. It is not performance chasing. You are not jumping into whatever is hot. It is not a guarantee of higher returns. Rebalancing is a risk control habit. Its main job is keeping your portfolio honest to the plan you chose. Let us look at a common mistake. During a strong bull run, some investors stop rebalancing because trimming winners feels painful. Their portfolio quietly becomes far more aggressive than intended. Then a downturn arrives, and the fall is much steeper than their plan was built for. The discomfort of rebalancing in good times is the price of protection in hard times. Another mistake is rebalancing emotionally instead of mechanically. If you only rebalance when you feel nervous, you are really just reacting to fear. The power of rebalancing comes from it being a rule, applied calmly, regardless of headlines. The whole point is to take the decision out of the emotional moment and into the steady plan you set in advance. For someone just starting out, rebalancing can feel like an advanced concept. But the foundation is simple. First, decide on a target mix that fits your goals and risk comfort. Second, write it down. Third, choose how you will check it, by date or by drift. Fourth, follow that process. The sophistication is not in the action. It is in the consistency. Over a long investing life, rebalancing works quietly in the background. It will rarely feel exciting. In some periods it may even feel like it is holding you back, when a hot asset keeps rising and you keep trimming it. But its real value shows over full market cycles, by keeping your risk where you intended and your decisions free from impulse. So here is the short version. Rebalancing means periodically adjusting your portfolio back to its target asset mix, because different assets grow at different rates and drift changes your risk. It enforces calm discipline, trimming what has grown and adding to what has lagged, all by rule rather than emotion. It will not make you rich quickly. It simply keeps your plan, and your risk, honest.